What if I told you that the 7 stocks I picked earlier this year are absolutely crushing the actual Magnificent 7 right now, even in this down market? So earlier this year, I picked 7, what I believe to be under the radar stocks that I thought could beat not just the market, but the so-called market leaders. And guess what? So far, they've done exactly that in the first quarter. But this, again, is not an I called it victory lap. From day one, I said we would track these picks quarter by quarter and compare them directly to the Mag 7 and the overall market. This isn't a prediction anymore. It is a scoreboard. Every 3 months, I'll be back here to show you exactly how things stand. Are my 7 winning? Are the Giants catching up? I'll show you here in a few minutes. But first, let me show you my 7 picks. Now, Sprouts Farmers Market. This is a company that I bought in the low 30s. And I even added the Magnificent 7, my Magnificent 7, because of what I believe to be a great grower. They're up 18% this year, and it's not a fluke. While the big grocery store chains fight for pennies, Sprouts is running its own game. Smaller stores, higher margins, and a laser focus on health-conscious shoppers. They're expanding into wealthier markets, pushing private label goods with massively huge margins, and doing it all without piling on debt. This isn't some bloated supermarket. This is a lean, efficient machine with pricing power. With plans to double their store count and a rock-solid balance sheet, Sprouts is scaling smart and quietly beating the big dogs at their own game. So let's take a look at our stock analyzer to see, because I want to show you guys what I believe about this company. Even though I own it, you might be surprised to see what value I would place on this company. So I did 6, 8, and 10% revenue growth for this company for the next 10 years. Profit margin, I did 4.5, 5.5, and 6.5. Because guess what? A big part of this company is they're increasing how much their private label sales are increasing. And guess what? Those private labels are 20 or 30% more gross margin than the rest of their stuff. I did PE of 16, 19, and 22, and my desired return of 9% to give me my intrinsic value. But remember, I'm not here for intrinsic. I'm not here to pay intrinsic value. I'm not here to match the market. If I'm picking individual stock, I need to have a higher desired return, which will be my margin of safety. But the stock's currently at 150. Hit the analyze button. Low price of 68, high price of 166, middle price of 108. So at the current price, I ain't adding more shares, but I still believe this stock can definitely grow. Now that first stock, Sprouts, was a bit under the radar, but this next one, it's an absolute household name. Yet most people overlook just how well they've crushed their industry over decades. That stock, guys, Southwest Airlines. I believe they're the anti-airline. While the industry drowns in debt and drama, Southwest boasts over 47 straight years of profitability up until COVID. How? One aircraft type, lightning fast turnarounds, and smart fuel hedging. With new routes, fuel-efficient planes, and business travel rebounding, Southwest has real upside. It's not as speculative as many people think. It's a disciplined operator in a very messy industry. In fact, the only downside of the stock is the industry it's in. But I believe there's an airline that's going to reward long-term investors. My bet is it's Southwest. Let me show you my thesis on Southwest. Before COVID, they were getting between 10 and 15% bottom line margins very consistently. Look at this. Profit margin, last year, 1.7%. Last 5 years, negative 0.6. Now you might sit there and say, oh, that's the new norm for them. I don't agree. I think margins mean revert, and they'll be back higher in no time. So let's see what that means for the company if it's able to do that based on our stock analyzer tool. Spoiler alert, I believe this company has the most upside potential out of any of the companies in my Mag 7. So I did 2, 4, and 6% revenue growth. Guys, for my profit margin, even though they used to do 10 to 15%, I only did 4, 8, and 12%. PE of 12, 14, and 16 because they're in the airline industry. I went lower, even though I think they can get a higher than 15 PE. And my 9% return, hit the analyze button. Guys, look at this. Low price of 21, high price of 102, middle price of 55. And again, that's with a very, very low PE. This is what I believe. So we've covered grocery stores. We've covered an airline. Now let's talk fintech. Most investors have completely written this next company off, but I think they're making a massive mistake. PayPal. They're a $1.5 trillion fintech beast trading like a busted growth stock. But don't be fooled. this company prints cash with over 400 million users, over 200 million merchants, and over $5 billion in free cash flow. In fact, it was almost $7 billion last year. It is still a dominant force in digital payments. Again, a company that people tell me is dead. Well, if it's dead, guys, let me ask you a question. How is their free cash flow up versus the average over the last 5 years? That's not the sign of death. BNPL is growing, and PayPal Complete Payments is going after enterprise customers. And the kicker, they're buying back $5 billion in stock this year. Guys, this is a $65 billion market cap business. They're buying back $5 billion of that. That's 7 or 8% of the entire market cap. The market's tossed fintech aside, but PayPal's network, their scale, and the embedded position in global commerce make it a classic value play. This is exactly when news follows a stock price, because the stock hit an all-time high of 310 back in July of 2021, a low last year of 57, and it's currently sitting at $64 a share. I believe that this isn't hype. It's a discounted cash machine with room to run. So again, some of these metrics, it's selling for a little under 10 times free cash flow. That's incredible for a company that's still growing. 5-year return on invested capital, 11%. 1 year, 13.5%. Man, it's kind of stuff we want to see in these kind of companies with a gross margin of 46% and a bottom line of 13 to 14%. Guys, I like it. I wish I had, so far, these 3 companies I've talked about, I wish I had 50 of them like that. I think I'd do very, very well. But let's go see what the valuation goes with Stock Analyzer tool. So PayPal, I did 3, 5, and 7% revenue growth for the next 10 years. I did 12.5, 14.5, 16.5 profit margin. But remember, their free cash flow is higher. I did 16, 20, and 24. And for my PE, I did 14, 17, and 20. And again, my 9% desired return, $64 a share currently. I have a low price of 58 to 75, high price of 128 to 187, middle price of 87 to 120. Now, even though the potential returns higher than Southwest, I was much more conservative, I feel, on my Southwest assumptions than my PayPal assumptions. So that's a big element here. Now, what have I told you? That this next stock dominates 90% of its market and is on its way to being an AI powerhouse. Ironically, everyone thinks AI is ruining this company, but I disagree. That company, Adobe. Adobe, I think, will be one of the big beneficiaries of AI. They're the quiet killer of the tech world. Profitable, dominant, and built to last. Creative Cloud is the industry standard with insane switching costs, locking in pros and creators alike. But this isn't just Photoshop and Premiere anymore. AI tools like Firefly and Sensei are supercharging productivity and pricing power. Meanwhile, Adobe's digital experience segment is helping businesses personalize marketing and drive growth. Like I said, AI will help Adobe. With over 40% operating margins, strong free cash flow, and consistent buybacks, Adobe is a cash-generating machine hiding behind a boring ticker. While the market chases hype, Adobe just compounds quietly in the background. And again, news follows the stock price. All-time high of $700 back in November of 2021. It is currently a lot lower. As of this very second, it's at $378 per share. Low debt, enterprise value to market cap is about $15 billion difference with high free cash flow. $7 billion a year for the last 5 years, almost $10 billion last year. And look at this, returns on capital growing. 22% for the last 5 years, 29% last year. So what's the company worth? Let's take a look at our stock analyzer tool for this company. Guys, I did 4, 6, and 8% revenue growth. And guys, look at this growing ROIC over time. Guys, that's so incredible. This company is getting better and better returns on its capital as time goes on. Profit margin, 26, 29, 32. Free cash flow, 38, 40, and 42. Guys, I put a PE of 18, 21, and 24. But if you told me 20, 23, and 26, I'd say, okay, makes sense. This is what's hard about investing. This is what makes investing an art and not a science. We don't know what the right PE is. But I do know it shouldn't be 15. It should be higher than that. And my 9% desired return, hit the analyze button. The stock is currently at 377. I have a low price. I'm going to focus on free cash flow of 350, high price of 644, middle price of 477. This is giving you a 12% discounted cash flow model return based on the current price. Now, this next stock has over 50% market share in the world's biggest e-commerce market, but you'd never guess it by looking at the valuation, and you'd never guess it based on where it's located. It's dirt cheap, wildly profitable, and totally ignored by Wall Street. Here's why that's a mistake. Alibaba dominates e-commerce with more than 50% market share, runs high margin, asset-light model, and boasts a cloud business leading China's AI-driven enterprise growth. Toss in Ant Group's fintech dominance and a $25 billion buyback plan, and you've got serious value hiding behind macro noise. Now, the unfortunate part is a lot of value investors started to love the stock at $78 a share, and it's skyrocketed this year, currently selling at $130 per share. But I still think there may be more juice in the squeeze right here. So let's go pull up Alibaba to see what our value is for this company. Guys, I did 3%, 6%, and 9% revenue growth. Guys, that's so low. They're in China. China's recession is 4 or 5% GDP growth. Now for profit margin, I put in 12, 15, 18%. And for free cash flow, I went higher because their free cash flow in the last 5 and 10 years has been higher. I did 15, 18, and 21. PE, 15, 17, 19, and again, my 9% desired return. Guys, even more reason you got to put in a margin of safety here because geopolitical concerns are out there and you got to worry about that. And that's part of your margin of safety. Stock's currently at 132. Hit the analyze button. Boom. We got a low price of 100 to 130, high price of 285 to 330, middle price of 175 to 210. So still a lot of juice left in this squeeze. If my middle assumptions occur, I can still make almost 16% return on my money buying the stock at today's price if my middle assumptions occur. We're going to talk about a company now that's quietly dominating an industry where trends change very quickly, margins are tight, and customer loyalty is rare. This next stock is turning the beauty game into a high margin machine, and most investors aren't paying attention to it at all. Let me show you how they're going to be pulling it off. That stock, I'm sure if you've watched our channel before, you can already realize it is Ulta Beauty. Ulta Beauty is the quiet powerhouse of a $100 billion industry, and it's winning on every front. With over 1,300 stores, almost 40 million loyalty members, Ulta's one-stop shop model blends drugstore, prestige, and luxury brands like no one else. It's not just retail. It services salons and personalized experiences that keep customers sticky. E-commerce now drives over 20% of sales, and Ulta's leaning into AI and private labels to boost margins. This is not a trend play. I believe this is a high return, cash generating machine in a category that is very, very, very unlikely to die. Beauty sells in all markets, and Ulta's positioned to keep compounding. So, take some quick ideas here. All-time high of 575 just last year in March. Pi Day, March 14th. $17 billion. This is what I love about the company. $17 billion market cap, $20 billion enterprise value. That $3 billion is debt. That includes their leases. And they generated $1 billion last year in free cash flow. So for a company that's retail, they're still growing smart. They're still increasing their cash flow. They've got almost 40% gross margin and a very consistent 10 to 11% bottom line margin with smart growth involved. That's what I like about them. So again, guys, I did a very conservative 2, 4, 6% revenue growth. Profit margin 9.5%. 10.25%, 11%, same with free cash flow. PE, 15, 18, and 21 with a 9% desired return. I believe this PE might be low because look at this growing return on capital. 19.5% over the last 10 years, 21% over the last 5, 26.5% last year. Hit the analyze button. And guys, I haven't even gone over the performance yet for Mag 7, my Mag 7 versus the real one. So just still wait for that one. We got a low price of $330. High price of $630, middle price of $455. If you pay today's price and my middle assumptions occur, you're looking at a little bit over 12% return. Imagine how that compares to the market. This next stock needs no introduction. It's one of the most iconic brands on the planet. But what most people don't realize, Nike is not just a shoe company. It's turning a tech-enabled, margin-expanding global machine. And the numbers tell the story that the headlines aren't. Guys, Nike has over 40% share in athletic wear and a direct-to-consumer engine that's boosting margins and growing. From Air Jordans to women's apparel, Nike's expanding into new categories. Remember, in the 90s and 2000s, to buy Nike, you basically had to go to a store. And that store would sell you Nikes for $150, but they bought those Nikes for $75 or some lower price. Now, Nike can go direct to you. International growth in China, Latin America, and Southeast Asia are all fueling future demand. As those countries get richer, they're going to start buying more. They're increasing supply chain efficiency, artificial intelligence, personalization, and consistent free cash flow. Guys, aggressive buybacks, long-term revenue targets north of 90 billion, 60 billion. I think this is the blue chip that still has some growth potential in there. So let's take a look at Nike here. Pulling up NKE. Again, this is a company where news follows the stock price. I say this in every video I do about Nike. When it was at 180, we said we were interested sub 100. Now, and everybody said, no, it's not everybody, but a lot of people said, there's no way it's going to go below 100. You're such an idiot, Paul. I'm like, yeah, I am. It's at $64 a share now. And guess what? News follows the stock price. Paul, Nike is dead. Go woke, go broke. This company sucks. They're not going to be able to compete, okay, fine, maybe so. But what world do we live in 10, 20 years from now with Nike gone? What would that look like? Is it possible? Absolutely. Is it probable? Those are the things we talk about with any company you invest in. So guys, let's look at Nike and their stock analyzer before we pull up the results of my Mag 7 versus the other Mag 7s out there. 3, 5, 7% revenue growth for the next 10 years. Profit margin 10, 11, and 12. PE of 20, 23, and 26, and my 9% return. Hit the analyze button. The stock's currently at 63. Low price of 60. High price of 118, middle price of 84, with a 12.9% potential return based on my middle assumptions and including the dividends. Now, guys, here is where we're going to compare my Mag 7 year to date versus the real Mag 7. Check this out. Did some quick research and some analysis on a few companies. Now, one of the things I didn't do was show the 8 pillars. The 8 pillars are an important part of my investment process. I start every investment look with the 8 pillars. I don't make decisions on buying or selling based on the 8 pillars. The 8 pillars tells me a story on what to look at next. What are the questions I need to ask in order to have a better understanding of the company? So if you want to understand the 8 pillars in more detail, click the link below and get sent a free, thorough PDF about our 8 pillars, why I created them, and how to understand each one of them. So click the link and we will email it to you right away. Now, for the moment we've been waiting for, here is the Mag 7, the real Mag 7's return year to date. Guys, before the market today, the Mag 7, I had 7 stocks at 10,000 each on January 1. We're currently sitting at 59,162, a loss of $11,000, down 15.5%. But here's what's interesting. Started off the year in the positive, went negative, positive, stayed up there, and then a collapse. Guys, this is too short term, like I've said 1,000 times in this video, to declare any victory. But what I said was, these 7 stocks will fall harder than the rest of the market. I absolutely assure you of that, and this is evidence of it. The Nasdaq's not down 15.5%. The S&P is not down 15.5%. That is what's crazy here. These stocks, I think, will take a beating. It rebounded a couple weeks ago, coming back down. Now, let's compare that to my 7 stocks. Guys, I'm in the positive. Not by much. And I got over 76,000 here at one point. Why? Mostly because of BABA. But BABA has retreated back significantly. There are a couple stocks here in the positive, 5 in the negative. But the ones in negative are not as bad as the other ones. Guys, I truly believe that a value investing approach works in the long run. Has it been masked lately because of the market and things that's happening, with euphoria and hype? Absolutely. There's no hype. No AI-fueled moonshots in my stocks, just disciplined businesses with strong fundamentals and real cash flow. Now, what do I think is going to happen in stocks? I have no idea. All I know is that based on the real Magnificent 7 versus mine, I do believe mine will outperform for a very long time. In the short run, I have no idea. But in the long run, there's more value to be made when you pay less for something. So if you're still watching, then you're not here for hype. You're here to learn how to build real wealth in the long run. So why stop now? We have a full course for investing. Just click the video linked on the screen. I show you exactly how I find undervalued stocks before the crowd catches on, or finding undervalued stocks that people have ignored. You'll learn how to read financials the right way, avoid overpriced traps, and build a portfolio that can compound for years to come, not just months. So if you're serious about long-term investing, this is the next step. Click the video. Let's go deeper. Thank you very much for your time.